Hello, this is Beast McFeast, and today we are going to go over how to buy an option. Can't promise that it'll be a good one. I'm just going to demonstrate how to go through the option chain to buy an option. Selecting a good one is on you, and it really depends on what you anticipate the underlying doing. The underlying being the ticker, the stock or ETF that this option is tied to. Before we get started, I want to be clear. I'm not your financial advisor, and I do not endorse any specific tickers or investing strategies that I mention here. I'm just demonstrating this for you. Investing involves risk, options involve unique types of risk, and you should know your risk tolerance and what these tools are before you engage in trading. The first thing you're going to need to do to trade options is to enable it through your broker. How to do this depends on your broker, and what kind of privileges they'll give you also depends on your broker and your experience and risk tolerance trading. All we need to buy an option is the lowest level of options approval in your account. You might have to click through some online menus or just call up your broker and ask them how to do this to enable options trading. To trade more advanced strategies such as spreads and naked options, you're going to need higher levels of approval from your broker, and this typically requires you to have demonstrated a history of good option trading, or just the history of option trading and an ability to pay back any kind of debts you incur using margin. Once you have options, you're going to need to select what you want to trade. So you want to pick an underlying with high liquidity. Probably a ticker that trades at least 1 million shares a day would be a good minimum number to indicate enough people are interested in this thing that I can probably trade an option or two on it. What you can also look for is open interest, which will kind of show you where that will be in your options chain later. And what I look for is about 50 times the open interest that I intend to trade. So if I want to trade one option contract, I'm going to want this, whatever that option is, to have about 50 open contracts at the minimum. What this does is it kind of reduces your bid-ask spread, and that allows you to better capture the true movement of this without having to worry about liquidity taking money from you on the front end or back end when opening and closing your trade. Another thing to look for when selecting your underlying is you want to pick an underlying that you're familiar with or have an idea of what direction it will go, because your options, buying options at least, will only help you profit if you know the direction or anticipate the direction correctly. For example, if you buy a call option, you're only going to profit off the underlying if it moves in the direction up, if it increases in value. On the other side, puts are used to hedge against a loss or to help you profit off of a loss. So if you anticipate bad earnings on something, you might buy puts on it. And if it truly is bad earnings and the underlying declines in value, your puts can go up in value. But you have to have an idea of which way it'll go first. And it's important to note that not all underlyings have options, so those are obviously not good choices for us here. And the underlying should display enough movement that it actually could increase or decrease enough in value to allow you to profit. Some things just don't move enough to make an option worthwhile. These contracts will be super cheap to reflect that, but still might be unprofitable. You also need to decide how long you want your contract to be. So over what time period do you expect the underlying to move in the direction you want? Longer dated options, or options which expire further out in time, are more expensive because you're paying more for that time. But turns out that the cost per day declines the further out your contract is. This extra time can give you longer to be right or wrong. And finally, you want to decide your exit plan. At what point will you cut losses? Maybe 10, 20%? At what point would you take profit? Are we talking 30, 40, and 50%? Or do you intend to exercise your contract? Which is rather rare. Honestly, most options just get traded a lot and then exercised by one person at the end. They often change hands many times before being exercised. And once you've decided on your exit plan, it might be good to stick to it. Sometimes you get caught in this mental trap where you see something move up sharply and you decide to move the goalpost for selling, and then you're going to watch it decline sharply after. It doesn't feel very good. It's not very fun. But it's up to you how you want to play it. I like to place orders almost as soon as I buy an option to lock in my exit plan. So you might bracket your option or do what is essentially a stop loss, take profit order. But after figuring out what option you want to trade, you need to open the options chain, and I will demonstrate that using the Thinkorswim platform, doing paper trading so I can execute an option using fake money. This will just give you an idea how to do it. Option chains are pretty similar across all brokers in that they display very similar information. At a good broker, you'll be able to customize what information is displayed, and some of it, some things I could display are not really useful for what I'm doing, so I don't display those. Here, I've kind of pared down the option chain to not display everything I might use when trading. So you're going to select the underlying you want. I'm trading SPY, SPY, the most traded thing in the market. Open the options chain, and it looks pretty messy. Notice that it opened up a bunch of dates here. These are your expiration dates. Under each of these, there are various strikes available. So let's just pick an expiration date, I don't know, 21 days out. And we have strikes here. These are different values of the underlying that the contracts would kind of revolve around. So with puts, you essentially want the underlying to go down below your strike. These ones are all in the money. Calls, you want the underlying to go up in strike to help you profit. So these ones are all in the money. The current underlying price on SPY is 443.56. Been pretty volatile lately, having some high swings. Notice I can select the number of strikes. So I can do 4 strikes, 14 strikes, all the strikes. And there are a lot. People are trading contracts, I guess. Somebody's trading contracts at the $190 strike. Probably not very many people, though. Let's see here. Wow, that's too many. So I'm going to reduce the number of strikes to 10. That's a more manageable number. And we're going to open up our thing again. There we go. So we're back here with 10 strikes. And sort of the most basic information you can get is what strike you want to buy at. So how far do you think the underlying will move? Well, I think SPY, which has fallen pretty sharply recently, is going to go up to $445 in the next 2 to 3 weeks. I might go over here and then I can see the price for this. And I can see how much it was sold for last. That was the most recent price that these are trading at. And we have 2 columns with prices. One is the ask and one is the bid. Of course, the ask is what you'd be buying at and the bid is what you'd be selling at. On Thinkorswim, it actually comes up and says buy or sell when you mouse over it. Pretty nice. So let's go ahead and spend some of this paper money. And we're going to select the 447 strike, which means that this contract would cost roughly $479 to open, plus whatever fees your broker has. So we're going to select it, and we want to make sure that some information is correct. We're doing a single contract or a one-sided spread. We're on the buy side of it, so we're not selling the contract. We could go to sell, and it'll change colors on us, but we're not going to sell this contract. We want to buy it, and we want to buy one, because the quantity is very important because you can quickly increase the cost of your trade drastically. By quantity 2, doubled the cost of my trade. I don't want to do that. Symbol is indeed SPY. The expiration and strike are the ones we selected. The type is a call. The other alternative is a put, and you're welcome to do that. It's a pretty similar idea. And then we have the price. It's $479. Now, it's moving in real time, so it's moving around quite a lot, actually. You can ask for a lower price. Try to save a few pennies here, or a few dollars, because every penny actually will translate into $1, and that's up to you. But it might make your contract less likely to fill, or not fill at all. Or what you can do is open this up, this lock, and this is pretty similar across multiple brokers, and that is set to the market price, whatever the market wants to pay for it. I'm going to lock it in because I don't want a weird accidental swing in the market to really blow up my price and have me pay 3 times what I want to for this. Our order is a limit order because it's not the market order. It's good for the day. So if the market closes before this order fills, the order is going to be canceled. And the exchange is just whatever it's trading on the best. Looking at that, we know this is going to cost $475, but we're going to chase the mid price down here. And just to ensure a fill for demonstration purposes, we'll agree to overpay. Oh, look at that. You can confirm. Total price, $478.65. That is your broker fee on TD Ameritrade. It's going to tell you like, what is this going to do to your buying power for stock and options? Send. That order is sent, indicated here. That little beep was it being filled. So that is how you open a options trade. You can also do the same on the sell side. It's very similar, but it has different types of risks. Now we're going to look at how to close it. So I'm on monitor on TD Ameritrade, and I'm looking at my positions. I only have positions in SPY right now, just for easy demonstrations. So now let's look at how to close an open contract. So I bought this September 29th, 2021 put a while ago. And it did not go my way. I need this below $434 to make any money. Man, that would have been a bad trade if this was real money, but it's not. So to exit the trade on something that you bought, you need to do something called selling to close. So I'm going to create a closing order. Let's create this closing order. And I have two of the contracts on this one. So I'm still on one side of the spread here. There's no real spread. It's just selling contracts. I'm selling two because that's how many I have. That's the correct date and strike. And the type is a put. Oh, this is a big loss on price. Man, when I bought that using this paper money, it was $437. Now it's $55. But that's okay. Again, we're on a limit order, so it will be locked in at this price, or at least try to sell it at that price. And just looking at all this, yes, we're selling these for $112 that we bought for these $430, $450 each. That's pretty rough. And that's how you do your sell order. Hey, it's done. So it's important to be familiar with the options chain and how to open and close trades before you get locked into a position. You see it green and try to exit and realize, I don't know what I'm doing. So go ahead and familiarize yourself with whatever your broker is. And there are videos out there that'll show you how to do it at pretty much every specific broker you could think of. Thank you for watching. Please go ahead and leave any questions, comments, or ticker recommendations in the comments. Good luck. Get rich. Bye.